Good afternoon. We'll call the special council meeting to order for June 28th, 2024. In the spirit of truth and reconciliation, we acknowledge the town of Edson is located on Treaty 6 territory, the traditional and ancestral lands of the Niqawak, Saulteaux, Siksika, Piikani, Kainai, Dene, Nakota Sioux, and the Epitimisoak Métis nations. We honor the knowledge of this land, the elders and youth which gather here, and our ancestors who have gathered here for centuries. Council, can I get a motion that the agenda for the June 28th, 2024 special meeting of council be adopted as presented? Go ahead, Councillor Chenard.
I'll make the motion to adopt the agenda.
Thank you, Councillor Chenard. All those in favor? That motion is carried unanimously. And we will go to reports from administration. We will have a presentation by Michael Trabish on the 2023 audited financial statements along with our auditor. So we'll do the presentation first and then take the motion. So go ahead, Mr. Trabish, if you want to introduce your guests.
Thank you, Mr. Mayor, and thank you all of council and to the community as well for your patience in us getting to this point here today. I'd like to introduce Mr. Edward Telford. He's our external auditor from JDP Wasserman. This afternoon we are going to take you through the financial statements and the audit findings letter, which Mr. Telford will walk you through. When he's concluded his presentation, I will walk us through the variances, some high-level variances between revenue and expenses, and I'll also close on where our annual surplus landed for 2023, which I know we've all been patiently waiting on. So with that, I'm going to bring up on the screen. Do you want to do your audit findings letter first or your statements first?
Financials first, please.
All right, let's bring that up. All right, it's all yours, Mr. Telford, and just let me know what page you want me to go to.
Is that working? Yes. You can start basically with page 5 here. So again, my name's Ed Telford, partner with JDP Wasserman. I'm responsible for the town's external audit. Good to be here. Kind of to pick up on what Michael was saying there. Thank you to all of council for accommodating us here today into your Friday afternoon. The audit was challenging, to say the least. Of course, there was extenuating circumstances. The province isn't going to grant an extension without reason, right? So, with floods and fires and evacuations and staff turnover and all of that, we're glad to be where we are here today within the province's extension period. So again, thank you for accommodating us. I'll walk through a couple of the main statements that make up your financial statements, as well as some of the important notes, and then the letter, as Michael said. So there are the two documents. The first here is the financial statements you have in front of you. This is the first main statement on page 5. So this statement is commonly referred to as your balance sheet. In municipal accounting, they call it the statement of financial position. So what it is assets and liabilities as of the last day of the year. So the top section has your financial assets, which are assets that are cash, near cash, or might be cash soon. So receivables, cash in bank, investments, all that kind of stuff. So they have us separate that out in the top section. So some of the key takeaways that you'll see there: total financial assets, 52 million, up from 46. So anytime your financial assets are going up, it's a good thing. The main thing here is the receivables. So definitely a large capital year. You've got all sorts of various grants creating this increase. So the first column there in bold is your actuals for 2023, and then we always show the comparatives for 2022. So you'll see the increase from 4.177 to almost 13 million. So there's everything from disaster recovery program, DRP, rec center grants, other cost shares in this increase. So these amounts have been received already after year end, or they will be received. So they're incorporated into accounts receivable. You'll see the first line item, cash and cash equivalents, hasn't really changed much, 37 versus 38 million. But we always like to look at cash and cash equivalents and investments combined. So you'll see the fourth line item from the top is your investments. So you'll see there's nothing this year where there's 4 million in the previous year. So this is a classification thing. Depending on what the town is invested in at any given time, we have to classify them as either investments or cash equivalents, which is why it would go 1 year it might go in the top line under cash and cash equivalents. The next year it might go in investments. So in the previous year, the town had longer term bonds, and because of their long-term nature, they were classified as investments. So the total of that was that 4.1 million. This year, the town's portfolio rests in RBC. They call it a high interest savings account in their portfolio. So it's designated then as a cash equivalent. So it's not that you didn't have any investments, you still have the portfolio. It's just what are the instruments within that portfolio that causes that classification issue. So again, we like to look at them in total. So cash and cash equivalents didn't change much, 38.5 versus 37. But overall, cash plus investments went down about 3 million. So the main reason for that, again, is your big capital year. So we'll look at what you generate from an operating surplus perspective on the next statement, and how that hits your cash in bank. But you still overall had a decrease of about $3 million in cash and investments, again, just because of that capital spending. And a lot of that shows up in that accounts receivable number, that 12.9 million. So overall financial assets up to just under 53 million from 46.9 the year before. The second grouping in the middle of the page, liabilities, includes all of your liabilities, whether they are financial in nature or not. And the net amount in the middle of the page, that net financial assets number, is the reason the province makes us organize this statement in this way, because they want to see what this net number is. So they take all of your financial assets, deduct the total liabilities, and they want to see what that number is as an indicator of your liquidity, or if you had to settle all of your liabilities, would you have enough financial assets as of December 31 to settle them? So you can see the net financial asset number, 16.877 million, which is down from 21, almost 22 the year before. But the fact that this number is positive, number one, is a big thing. At a lot of municipalities, this number can actually flip negative. So when you use debt to finance your capital asset additions, you take the hit for the debt you've incurred under your liabilities, but when you buy the capital asset with it, it goes under the bottom section, non-financial assets. So it doesn't factor into the net financial assets. So you're taking the hit for the liability, but you don't get credit for the asset, which can flip that number negative. So for a town your size, at 16.8 million, that's definitely still a very healthy net financial asset number, especially considering when you look at this liability section in the middle of the page, you're going to notice this bottom line item, asset retirement obligations, $10 million, just over $10.5 million. Compared to next to nothing last year. So the reason for this is that this accounting standard is new for 2023. So the idea is we have to estimate in today's dollars, so as of December 31, 2023, in today's dollars, how much money would we need potentially as an estimate to settle all of these asset retirement obligations, which is the potential asbestos based on engineering reports that could be in your underground utilities, your buildings, reclamation for landfill, all that stuff that's going to be spent over the next however many decades. We have to make an estimate of, in today's dollars, about how much would we need to kind of put in an investment portfolio to earn interest to be able to meet those current or those future cash flow requirements. So that number is an estimate of just over 10.5 million as of December 31. So you'll see that that significantly increases your total liabilities, whereas last year it was 25, now it's 35. That $10 million is that asset retirement obligation. So the fact that your net financial assets still stayed at 16.9, 17 million, only going down $4 or so million from the year before, is another positive indicator, because with that liability number going up 10, your net financial assets could have potentially gone down by 10 or more. So only going down 5 is just another kind of positive indicator. It's not the greatest indicator of strong financial position, but again, it is important to the province. That's why they make us organize this statement as they do, because they do care about that number. Other takeaways from the liability section, your long-term debt has gone down, so no new debentures for 2023. So 9.8 million, and we'll look at the note for that in a minute. Deferred revenue, 8.8 million, pretty much the same as the year before. A lot of this is MSI. It's important to note the MSI program is coming to an end. This money needs to be spent. With the new rec center, that isn't going to be a problem. Accounts payable and accrued liabilities, the first line item you're going to see is gone up pretty significantly from 3 million to 6. So it is a liability. You don't like to see those numbers going up, but it's not any cause for concern when this number goes up necessarily, because a lot of what drives that number is just what you happen to be doing in terms of your capital work near year end. So if you've got a lot of work that you're doing one year in November and December, and you're getting those invoices in January, February, they're payable as of year end because the work was done before December 31. The year before, you might not have done as much work in November and December, so you're not going to owe as much as of December 31. Again, this statement is all as of December 31. So the number's gone up. It's a liability, it's gone up, but it's just because you were doing more capital work in and around December this year compared to last. So not a concern there. Lastly, the bottom section is your non-financial assets. So these are things that are not cash, not near cash, never really going to be cash. And the main thing is your tangible capital assets, obviously, as it is with any municipality, 125 million, up from 115 million. Again, large capital year this year, $15 million worth of additions, less $5 million of amortization, which is the expense that we recognize each year based on how long we think those assets are going to be in use, is the net number of 10. And that's the change from year to year. The big takeaway is the bottom number. So that's your accumulated surplus, 143,649, up from 138. So if we could jump to that note 10 is on page 22. This is always an important note to look at. So you'll see it's made up of, I'm sure everyone's there on their hard copies. It's made up of several different components. So the idea here is your accumulated surplus, each component has an offsetting asset to it. Because your capital assets for any municipality is such a large number, that equity and tangible capital assets, number at that bottom, that's the offsetting assets for that are your capital assets. Again, those are not cash. They're never going to be cash. You're never going to sell your roads and your buildings and your vehicles. So they make us split it out, because otherwise municipalities, in your case, they might think that they have $143 million to spend because that's our accumulated surplus. You'd think, well, isn't that in reserve? Not how it works. We got to separate out the equity in your capital assets, because again, that's never going to be cash. You're never going to be able to use that value to fund any future costs you might have. The other three buckets, the unrestricted, and then your operating reserves and your capital reserves, those offsetting assets are your cash in bank, your investments, your receivables, stuff that's cash, near cash, going to be cash soon. So that is available to spend in future years on capital, operating, whatever you might need it for. So the first key takeaway, and Michael will touch on this later with his slides, is the unrestricted surplus. So $5 million is what's left at the end of the day after funding all of the capital additions that weren't funded through grants or there was no new debt taken on this year, but whatever reserves we use to fund both operating and capital expenditures, what's left at the end of the day with our operating surplus incorporated is $5.1 million. So that could be put into reserves by council. It hasn't been allocated or earmarked by council specifically to any purpose yet. So it's sitting in unrestricted. So it could be put into reserves. It can be used for next year's needs, but that's what's available at the end of the day. The other two reserves, or the other two buckets there, are your operating and your capital reserves, which are summarized in the other note, but haven't changed significantly once all the ins and outs for the year have been posted, as far as what reserves accumulate what revenues and what surpluses, and then what reserves are funding certain operating and capital costs. So at the end of the day, they haven't changed a whole lot. And then the important thing again is the 5.1, which is available for future use or to be put into reserves, however council and management decides. So that is that note summarizing the surpluses. The other main statement that I'll walk you through is on page 6. commonly known as your income statement. Again, municipal accounting, they make us give it the fancy name of Statement of Operations and Accumulated Surplus. So, again, Michael will break down some of the variances as far as the revenues and expenses. So the previous statement we looked at showed all your balances as of December 31, right? Assets and liabilities. This statement is different. As you can see, it's showing your bottom line, your revenues, your expenses, all that good stuff. So as far as the top section, your operating revenues, generally year over year, I mean, we had the COVID years, we had a lot of volatility. But generally speaking, from a municipality standpoint, our operating revenues are usually pretty static and close to budget. We generally know what we're going to collect each year from taxes and utilities and operating grants and all that. So there's usually never any big surprises. As far as the variances to the revenues, I'll just speak to, firstly, there's disaster recovery revenue included in government transfers, which is that second line item from the top. Of over $2 million, causing a variance there. And the other one is the investment income. About halfway down, you'll see way over budget. Everybody is going to budget for this conservatively. You never really know what you're going to receive in terms of investment income and how rates are going. But basically, post-COVID, with the economy recovering and then inflation on top of that, one thing that inflation does create is higher rates of return on your investments. So every single one of our municipal clients saw a huge variance here where you're earning $906,000 versus $178,000. So on this statement, you got the budget in the first column and your actuals are in the bold in the center with the prior year to the right. So the biggest variance as far as the total operating revenues, 33.5 versus 31 budget, is your disaster recovery. But that revenue has offsetting expenses, right? So it doesn't really hit your bottom line. They kind of net out in revenues and expenses. Whereas the investment income, that 800 or 700 and change $1,000, there's no offsetting expenses to that, right? So you're over budget by that amount, $700,000 and change. That's going to flow right into your bottom line. As far as the expenses go, the town's policy has been historically to not budget for amortization. So like I mentioned earlier, amortization is us accountants doing an estimate based on how long we think all of your capital assets are going to last until they need to be replaced. And we expense a certain amount of that every year, which is representing, in our estimation, what you should be reinvesting as part of your capital budget each year to keep your infrastructure in the current state that it's in. So because the town doesn't budget for that, all of these numbers show variances to budget. All the actuals are going to be higher, generally speaking, because the actuals have amortization. So there's a better schedule to look at expenses, and it is on page 13. So we'll jump there quick. So the last statement we looked at, it shows all of your expenses by function, whereas this schedule requires us to show all of the expenses by object, so the actual type of expense that it is. And this is good because it separates out amortization. You can see the third line item, no budget, there's your $5 million of amortization. So when we look at this schedule, we can better understand how your expenses did based on what you budgeted. So a few key takeaways from here. The first one, the biggest one, salaries, wages, and benefits with the turnover this year came in under budget, just over $10 million versus $10.6. The contracting and general services, that's where that DRP expense is held, that over $2 million. So that's over budget. But again, there's offsetting revenues to that. So it's not affecting your bottom line. It's mostly covered by the DRP program in terms of what we expect to recover in the future for those costs. The transfers to individuals and organizations, near the middle there, the budget of $525,620, you'll see the actual is significantly higher at $963. That is the capital contribution to the West Yellowhead landfill of over $400,000. So that's the difference there. And you'll also see this asset retirement obligations accretion expense, fourth line item from the bottom, where it shows a $67.5 budget versus $318. So that's the new accounting standard. It's non-cash in nature. That is related to that $10 million liability that we looked at. That liability goes up pretty much every year. If everything else stays the same, that number kind of goes up each year to represent we're getting closer to those years where we're going to have to incur the costs to reclaim the land at the landfill, to remove asbestos when we knock down a building, where we replace utility lines, that sort of thing. So that's an expense, but it's non-cash. So the key takeaway here is when we look at the bottom line of operating expenses, they're 32.5 versus 25. If we take the actuals and we factor out amortization, which you don't budget for, we factor out the DRP, and we factor out that accretion expense on asset retirement obligations, the town came in at 96% of budget. So very near budget, but also below. And you'll see that the rest of these line items that I didn't mention specifically, they're basically all coming in near budget or just below. So overall, when we're looking at this, operating revenues and now operating expenses, we can say kind of confidently, like, management, you did a pretty good job budgeting here, because you ended up basically where we thought you would based on your budget, with the biggest difference being that the disaster recovery, again, right, which has offsetting revenues and expenses. So if we jump back to the other main statement on page 6, this net number, now that we've looked at operating revenues and expenses, this annual surplus before other, near the middle of the page, that's the number we're most worried about as far as your bottom line. So your actual bottom line is that annual surplus number, which is the third line item from the bottom, 5.5 million. The reason we care less about that number than the number above this is because of this other revenues and expenses section. So the other revenues and expenses, it almost 100% of the time, those numbers have to do with your capital assets and how you're funding them. So the big number is that government transfers for capital. 3.6 million last year, 2.9 this year, and then budgeted just under 24, expecting to get a lot more work done on the rec center, I'm assuming. Those numbers can fluctuate greatly year to year, because those numbers, that government transfers for capital, that is the amount of grants you are claiming in the year on costs incurred. So the amount of costs that you incur in the year on your capital assets, however much that you're claiming of that money in grants, determines what that number is going to be. So for example, one year you might have a $10 million capital budget, and you expect to fund 8 million of it through grants. If that comes to pass, your number on your financials will be $8 million. The next year, you might have a same $10 million budget for capital, but you expect to fund 8 million of it through reserves. Well, then on your financials, you're only going to have $2 million of revenue. So it sways greatly from year to year, depending on if you're saving up to use deferred revenue in the future, or if you're using a lot of it in that year. Another reason we don't like to worry about those numbers is because all of those revenues and those expenses, if they have to do with your capital assets, they flow into that separate fund we looked at. So the accumulated surplus note, that equity and tangible capital assets, that's where those revenues and expenses flow into. They don't affect your reserves. They are illiquid. That's the equity tied up in your capital assets. Again, not cash, never going to be cash. So because these numbers in the other revenues expense section flow into a separate fund and don't impact your unrestricted or your reserve numbers, we worry less about it. The key takeaway, again, is that annual surplus or deficit before other, which yours is positive, $1 million, just over $1 million, with 2.8 the previous year, and 4.6 budgeted. So the fact that it's positive is a good thing, especially when you consider amortization, because remember, amortization is in all of those expense numbers. So because the number is positive, that means you're funding 100% of your amortization. So again, that is an estimate of what we think you should be reinvesting in your capital budget every year to maintain your infrastructure at its current state. So if you're funding it every year, and that number's not negative, because at a lot of municipalities it can be, everybody does it different. Some municipalities will choose to fund half of their amortization, a third, 2/3. So you are funding 100% plus some, because not only is it positive, it's positive by $1 million. And when we add back $5 million of amortization, we would consider your operating surplus on a cash basis to be about $6 million. But that doesn't include whatever capital work you're going to do, because the capital work is going to eat up your cash. So you've got a $6 million operating cash surplus, but obviously we saw your cash didn't go up by $6 million because a lot of it was spent on capital work in the year. So again, the key takeaway is it's positive, you're funding all of your amortization. And in a challenging year like this, especially, having it be positive by $1 million is mainly generated from the investment income that we looked at, where that positive variance of about 900 and some thousand, that's basically where that number is coming from, all else being equal. Another key note we always like to look at is the debt limit note, which is on page 21. So especially considering, I know there's other funding sources, but especially considering the large rec center project the town is undertaking, this note is required every year, and it shows based on number 8, actually, sorry. Note 8 shows based on the province's metrics how much debt you could take on before they would consider the town to be having any insolvency issues. So the total debt limit based on the province's calculation is that $50 million number. The total debt currently is just under 10. So theoretically, the town could ask the province for $40.5 million in debentures, and the province wouldn't have a problem approving it. They would say, you're still within our limits. Not that you want to get that close or anywhere near close to that. The less debt, the better, obviously. And if you've got the reserves to use it, you're always gonna earn less interest than you're paying on interest on debt. So, but theoretically, 40.5. The second section is less important. The service on the debt, that's how much you would have to spend on principal and interest in the following year on your debt. But it's basically the same kind of calculation as the above section. So the key thing is to know that you've got room of about 40.5 million. So, I mean, I guess the key takeaway from a financial standpoint on that is not that you've got that much room, but that, not that you've got that much room to use it on something in the future, but the fact that you've got that much room, meaning the town isn't very highly leveraged. It's only accessed 10 of 50 possible $1 million as of December 31. So it's not like you're in any kind of solvency crisis or anything, as far as the province is concerned based on their metrics. So when we look at the financials overall, those are the main statements and the main notes we always look at. We look at the financials overall. There's nothing really significantly negative to kind of point at. All of the arrows are kind of going in the upwards direction. You've got your $1 million surplus from operations, funding 100% of your amortization. Your net financial assets are still at $17 million. Even incorporating the new asset retirement obligation accounting standard of $10 million, it's still positive $17 million. You got plenty of debt limit room. I know you've got a huge project that you're undertaking, but as of December 31, like I say, there's not really, everything's kind of pointed up. There's not really anything to point at in these financials and say, we're worried about the financial position of the town here or there. Any questions on any of the statements, any of the other notes? I know you haven't had a lot of time to digest these and review the details. But any questions? Oh, that's all I had as far as the notes on the statements themselves.
Well, thank you very much for your presentation, and we will open the floor to questions. Go ahead, Councillor Chachka.
Thanks. Through the mayor to Ed, thank you for running through that. So you mentioned that our you mentioned that the amortization is a non-cash, kind of non-funded, but then you said that our amortization is funded. Is it a theoretical funding because based on the way the statements are put out that we do have the money should we need to utilize that, like say the landfill reclamation, or when we need to reclaim the landfill, do we then have to come up with the money within the statements?
So that's the asset retirement obligation liability. There is a component of amortization to that, but we're kind of talking about two different things. The amortization, I guess I should say, clarified, probably what's confusing is I said the town doesn't budget for amortization, but they are funding it because you've got enough bottom line from your operations that when you factor in amortization expense, you've still got a surplus. So that means you're funding all of your amortization. If that number was negative, we would say, okay, well, it's positive if you take out amortization. And then we'd figure out, okay, how much are they funding of their amortization, that $5 million? Is it half? Is it a third? Is it 2/3? So you don't budget for it, but you are funding it through the revenues that you're collecting and the rest of your budgeted expenses. That is non-cash. So that's kind of the amortization side. But then the separate thing is the asset retirement obligations part of it, which is the expense is that accretion expense, that 200 and some thousand. That is also non-cash. And that changes by how much that estimated liability changes each year. So that $10 million, again, that's today's estimate of if we put that in a separate bank account and earn interest in 10 years when we expect to knock down this building and pay for this asbestos abatement, we'll have enough money in that account to pay that cash flow. And then when we have to reclaim some of the cells at a landfill, we've got enough cash in today's dollars, right? So it's completely non-cash as far as the liability and the expense side for both amortization and the accretion and that liability. So we like to factor it out when we look at what is your operating surplus or deficit without that? You know, what do your expenses look like without that kind of stuff? Because it is non-cash. It's an accounting estimate. We should care about it. So when we look at your net financial assets, for example, at 17 million, we want to make sure that we're counting that 17 million with that theoretical $10 million liability included. We want to look at your bottom line with amortization posted, because it is an estimate, but it is a real cost. There is a cost to, like I say, reinvesting in your infrastructure each year. And what is that number? Well, that's what amortization is trying to do. So we want to look at your numbers with it, but at the same time, you don't budget for it. So we want to factor it out when we look at, you know, your expenses and, okay, well, how did we do compared to what council approved? They don't budget for amortization. That's just their policy. They're funding it, which is great, but they don't budget for it. So we got to factor it out when we look at some of the variances. I don't know, does that answer your question on kind of both parts?
Thank you. Council, do you have any further questions for the auditor this evening on his presentation? Seeing none, Mr. Travish, so does that conclude this portion of the presentation and we can accept the financial statements?
Mr. Mayor, I'm just going to ask Mr. Telford if he wants to do the audit findings letter next before. Okay, we'll do the letter and then I'll do my PowerPoint presentation.
Okay.
Thank you.
So essentially, at the end of every audit, the auditor has to issue a report or a letter similar to this to whoever's in charge. So it could be, if we're auditing a for-profit business, it might be the owner, it might be town council, it might be the board of directors at a not-for-profit. In your case, obviously, it's town council. But we're required at the end of every audit to issue something similar to this. The reason being is you'll see a lot of these headings. We have to report anything of significance that we think merits council's immediate attention. So there is a separate letter that we issue to management. We make note of it in this letter. On the second page, I do believe. Yes, near the middle, under significant deficiencies in internal control, in that second paragraph, we like to put in this letter to council that, you know, making you aware, hey, this other letter does exist. The purpose of the other letter to management is our lighter housekeeping kind of accounting recommendations of things to kind of clean up. We always have recommendations. If there's anything that rises to the level that we think council needs to know about it, then it would go specifically in this letter. But at the same time, we want council to be aware, if they want to see this other letter, you can certainly request it from management. So that's the key takeaway from this letter. Like I say, there's a lot of headings on here talking about the kinds of things that we would have to report to council if there were any. So basically there are none. You know, if we have any significant disagreements with management over their accounting policies and how they're recording things, it would be in here. If we weren't getting information in a timely manner and having a lot of trouble getting answers, it would be in here. If there was any accounting estimates that we didn't agree with management on how they were estimating things, like the asset retirement obligation, liability, or something like that, it would be in here. If there were any errors that we found that management was not willing to correct for whatever reason, it would be in here. So again, the short answer is there's nothing of significance to report other than this other letter exists, and we do make note of on the first page, under near the bottom, there's significant difficulties encountered. We do make note that there was the filing extension and the completion of the audit was delayed. But that's just more to cover ourselves. The people that review our files, that's one of the first things they would look for is, okay, they were late in filing. Did they get an extension? Was council aware of everything? So we have this in this letter to council just to say that, yes, if they weren't aware, we definitely put it in the letter. So those are really the only two key takeaways from the letter. But again, if you want to, once we finalize the letter to management, if you want to see a copy of that, you're perfectly, it's perfectly acceptable. You can request it from management and see what our other lighter recommendations are. And that's all I had on that. If there was any other questions on the audit process or anything like that, that's kind of what the letter is for.
All right. Any further questions for the auditor at this point? Seeing none, go ahead, Mr. Travish.
Thank you, Mr. Mayor. I will take us to a little bit more of a granular level now and look at the revenue and expense variances and also the annual surplus. Mr. Telford has already touched on a number of key observations during the year, and he did a great job and has noted a lot of the variances that administration has also seen in our statements from 2023. So firstly, we would just like to remind council that we are following our internal reporting policy, which is F-FR-1. And that policy requires us to bring our year-end statements from December 31st to you in February in terms of a report at where we're at in terms of the year-end, which of course highlighted in red there we miss, which is why we're now playing catch-up today with this presentation from administration. Again, March 31st is under the policy. The auditors would have typically presented the audited financial statements at that period of time, so we're playing catch-up again today. And then, lo and behold, we'll be back at you in July with a report up to the end of June of this year. So we are slowly getting caught up, and I guess we'll see more of those red flags go away and we'll get back on schedule. So again, we're going to look at some noteworthy or just some variances year over budget for 2023. And again, Mr. Telford has already touched on some of these, and I'm just going to go through some of the bigger items. Again, in our revenue lines, the $3 million over budget, again, the lion's share that's driving that change is the disaster recovery funding that we received for 2023. And also Yellowhead County, there was an overage in the revenue we received. That is the two main drivers there. In investment income, again, Edward talked about this. We are way up in interest, and then it was offset by a bond sale where we ended up at $728,000 to the good. I'm looking at court fines down almost $600,000. Again, the big driver there is probably because your town was evacuated twice last year, and I'm assuming that a lot of the driver there would have been less fines were being issued during that period of time. And the last big item we want to highlight on in terms of the revenue variances is in 2023, we had an invoice that we sent to Alberta Forestry for some resources for fire and equipment and manpower, and that was not in our budget. So that's what's driving that overage in budget as well. Moving on to the expense variances. Again, there's that offsetting expense now that you see going up in protective services where we spent the money on the disaster recovery program, which was offset in the first slide by the incoming revenue. In utilities, the two big drivers there, again, we talked about depreciation, so you're going to see that come up quite a bit here. Because it's not in the budget, depreciation is higher in the actual column. And I'm thinking that for 2024 and forward in 2025, we should probably start putting our budget for depreciation into the budget so that we don't have these variances at the end of the year to explain. So in terms of utilities, 1.9 million of that variance is because we didn't have depreciation in our budget. And the other one is 471,000 was for a fee that we paid to the Regional Waste Management Association. Going down to roads, streets, and equipment, again, a major driver there. If you back out the depreciation, as Edward was saying, management did a great job at coming in on budget when you factor out the depreciation. Recs and Park, a couple of items there. They were under in their administration budget, over again for depreciation, and under 106,000 in community development. General administration, we had some savings in contracted services and 54,000 in, I'm trying to think what that one was for, not coming to me at the minute. I will think of it and get back to you on that one. The next one, again, 80,000 for depreciation. Public health and welfare, 71,000 variance, 86 again depreciation. Offset by some savings in FCSS. Planning and development, they were underspent 177,000 in salaries and others. So I guess there was probably some vacancies in that department last year. And legislative, almost on budget. They are under by 61. There was some savings in contracted services and 16,000 in salaries. So again, just a little bit more granularity on what drove the changes from the actuals to the budget. Edward talked about this slide as well in his presentation and did a good job of explaining it. That big $23.9 million budget actually included the budget for the ISIP grant last year for the YCE project, which we have not recognized any costs for yet. So that budget is still sitting there, and that's why there's such a huge variance there. And then there was the Vision Park contribution, and we had a couple of vehicles last year. I understand we had to dispose of them off of our books because they were set afire. So that's a small loss there when we took those off the books. The most important slide is the one that's coming up next, and this is the one that will help council walk through without getting into too much detail. But Edward spoke about the $5.5 million excess of revenues over expenses. And the reason I like this slide is it really does two things. It checks to see if our reserves are funded, and it also helps council understand why they have this $5.1 million now to decide what to do with. And I'm going to work with CAO Beverage to make some recommendations on that when we do our reserve review. But essentially, we start by taking last year's unrestricted surplus, which was 1.3. We add the excess of revenue over expenses that Edward walked through earlier. And we add and subtract a whole bunch of complicated journal entries, which I'm not going to walk you through today. But at the end of the day, there's $5.1 million left over at the end of the year. So if you look at your balance sheet and look at the cash and temporary investments number, that number from the balance sheet is $38 million. So I just noted it down here at the bottom. And what is important for council to do is to look at what they have sitting in the unrestricted surplus and the restricted surplus. And lo and behold, those two numbers almost come to $38 million. So we're in a very healthy funded position. I want to reassure council that those funds are sitting in the bank account and they are liquid. So that is the test that I like to show and explain to council on top of what our auditor has found in our books and records. And I do want to mention, Mr. Mayor, that there is about $657,000 that council approved us to use out of the year-end surplus for the YCE project. So I'll work with CAO Beverage to bring forward an administrative direction to council that we earmark 657 of this to fund the $80 million project for YCE, and then we'll work with CAO Beverage to make recommendations on what to do with the balance in terms of analyzing the optimal balances in the restricted reserves. And with that, I will let council ask any questions about the presentation, and I will conclude my slides, and I will turn it back to you, Mr. Mayor.
All right, thank you. Council, do you have any further questions for Mr. Trabish? Before I take those questions, I just want to thank the auditor, Mr. Trabish, your staff, for, I know it's been a long haul to get to this point, and a lot of heavy lifting to get the financials done here this afternoon. So I want to thank you for that on behalf of council. So with that, Councilor Moore, you have a question.
Yes, through the chair to whoever could answer this. I'm looking back at page 20 here, accounts receivable, and it says trade and other. I'm kind of interested in what other means. Thanks.
Yeah, I can start that one off. So again, there's various grants that led to that. We looked at it went from $4 million to 12.973, your accounts receivable, which obviously makes up a lot of different components in that note. So there's a lot of different grants in there. So it's got disaster recovery, cost shares, the rec center. There is, if I look at that note, obviously a lot of other components. One thing I had noted from this note as well, that utility accounts, sorry, it's not on screen, but everybody has it in front of them. Utility accounts, the second line item has gone up significantly. It's not because that's a lot that's owed to the town more this year than last on utility accounts. When we do these financials, we're required to consolidate the 20% share in the West Yellowhead landfill, and they had large receivables this year. So that's where it shows up. Because they're basically a separate utility, right? So it shows up under utilities. So that's the increase there. But yeah, in trade and other, that's where most of those grant receivables are ending up. And disaster recovery is probably the biggest. It's in the neighborhood of $2.5 million. So that's the biggest one there. But all sorts of other grants. It's not uncommon when you have such a big capital year that there's going to be all these other funding sources that you haven't necessarily received the money for yet. But again, being it's accounts receivable, it's either been received as of today or it will be received. So that's why it's classified there.
Council, any further questions? Seeing none, I will take a motion that council approve the 2023 year-end financial statements as presented. Go ahead, Councillor Chachka.
I so move.
Thank you, Councillor Chachka. Once again, I'll open the floor. Any questions, comments, or concerns? Seeing none, all those in favor? That motion is carried unanimously. Before I take the next motion, CO Beverage wanted to do some introductions that I forgot about earlier. So please go ahead, CO Beverage, if you'd like to introduce the people you wanted to introduce.
Thank you, Mr. Mayor. I have the pleasure of introducing our newest SLT member. Chris Chapates is our newest member to the team. He is our general manager of corporate services. Chris has a strong background in the forestry industry. However, his leadership experience and his education are extensive. So we really look forward to working with Chris, with the team, with corporate services in one of the key things that looking at this position and efficiencies are what we're trying to find with the organization, and not only with corporate services, but organization-wide. So we're looking to Chris to help guide the organization through that. So if Chris, if you'd like to say anything, you're more than welcome to, but you're not obligated to.
Go ahead, Chris.
Thanks for the introduction. I'm super excited to work with everyone. Again, my experience in working in forestry, though, I'm going to need a little bit of help, and I'll be asking a lot of questions and stuff about protocols and procedures and stuff, but I'm super excited to work with all of you.
Excellent. Well, welcome to the team, Chris, and we look forward to working with you. And you're ready to live here, so that's an added bonus as well. So thank you very much. That concludes your introduction, CO Beverage. Thank you. Can I get a motion, please, that the meeting move into a closed session pursuant to Section 24, the Freedom of Information and Protection of Privacy Act? Go ahead, Councillor Moore.
I so move.
Thank you. All those in favor? That motion is carried. All right, thank you, everyone. On behalf of Town Council, we'd like to thank CFO Travish, our auditor, as well as the entire finance team, Tyler as well, who's been helping us through the audit process. We appreciate the incredible hard work and dedication of our finance team to get to where we are today. So thank you very much. With that, I will take a motion for adjournment. Go ahead, Councillor Chenard.
I'll make the motion for adjournment.
Thank you. All those in favor? And that motion is carried unanimously.
Michael, you're